But if you go to most banks and you really sit down and you walk in the door and you have a conversation with almost anybody at that bank, I have found, because I have friends that are in those positions, that and I mean this nice, they don't understand banking. Like, they have no context of what's really going on often. The people who understand banking are the ones way up the food chain who know what fractional reserve banking is and how money turns.
It's not about the rate of interest, it's about the volume of interest. A wise man once said that, named Nelson Nash. But, one of the things that I think is really important is people need to vet the institutions that they're holding their money in. And the reason I say that is because we can use Silicon Valley Bank as an example. I personally know someone who lost millions in that bank because Silicon Valley Bank, even though banks are regulated, they were doing things that went unregulated, essentially.
Banks, institutions, government, all these people want our money on a consistent, systematic basis and hold on to it for as long as possible. You start to understand why, because they're more focused on cash flow. Well, if they can get you thinking about the miracle of compound interest, oh, I got a dollar cost average, oh, I need to pay off my house as soon as possible. Well, what you're doing is you're feeding their system faster than you are feeding your own system.
Welcome to the Cashflow Legendz podcast with your hosts, Nate, Brandon, and Brock. Remember, our insights are not direct financial advice, so consult with your financial team before making any decisions based on the topics discussed in this show.
Welcome back, everybody, to Cashflow Legendz. Nate and Brock and I are always stoked to get to spend time doing this together. Before we hit record, we were reminded, we always open up in prayer, that we really get to do something that we enjoy, and that's a blessing. We're just hitting record and documenting it, which is pretty cool. If we bring any kind of value to you and you're sharing your time with us and you feel led to do it in a way that you feel good about, a review is always fantastic. 5 stars is the most you can give, and we like that a lot if you feel like that's something that we deserve. If you don't, message Brock or Nate and talk to them about it before you give us a 3 or a 4. Other than that, guys, we're going to talk about a subject that I think, if you really polled America and said, do you understand how banks really work? I think most people do not have a real understanding of how banks operate. So is your money safe in banks? Is it a good place to deposit money? And so we're going to dive into, what were y'all's thoughts on how banks operated and what are they now? And then we'll kind of chase this rabbit a little bit and see where our conversation goes. Brock, I know that leaves it wide open for you. Go wherever you want to.
Yeah, that's a broad question. Most people don't realize, like, it's not just like, oh, banks just hold your money and then you're good to go. Like, there's all kinds of weirdness in the banking world, wildcat banking, fractional reserve bank, all this stuff that's out there that majority of America, like 99% of America, has zero clue about what's going on, about how it actually works. But I think at the very basic level, it is, hey, there's an institution that is going to pay you an interest rate for your capital so they can control it. And then when they get your money, they're going to turn around and lend that back out to somebody else and do the things that they want to accomplish at a higher interest rate. So they are able to make their money by they're able to make their money by controlling your capital with a good interest rate and then turning around and asking for a greater percentage rate from somebody else. That would be like me saying, hey, Brandon, I'll give you 1% if you give me $100. And then Nate come to me and saying, hey, Brock, I need $100. I'll pay you 5%. And so my money is made on the 5%.
Yeah, I think that's something that a lot of people don't fully comprehend. Is that a bank is a business and the job of a business is to turn a profit. Well, how does a bank turn a profit? Just like Brock said, hey, they've got to use our money to go create value for themselves, and they're simultaneously creating value for us. When they're paying us interest, they're creating value for someone else when they are charging interest, because they're giving them access to capital. And then they're creating value for themselves because of the difference between what they're paying in interest versus what is being paid out.
I think we could go so far down to the depths of this that it could create confusion. So I say, let's stay at the top of the iceberg right now. And first, just think of this. When I ask people in my conversations daily, depending on where they're coming from and if they have any background in business or any banking information, if they have a very basic knowledge, I ask them what their number one thought is that a bank does for them. And most people's answer is it protects my money. Okay. And I get that response often. And that's what I thought. Because when I grew up being raised on how to make money and save money, it was save a certain amount of money in your savings account, off of every check you got paid for mowing yards. That was my first income producing job I ever had. And so most people, they think that banks are created to protect our money. And so at a very basic level, when you have that conversation, banks are made to capture our deposits, and they will do anything they can to get as many of our deposits as possible. So let's talk about the value of deposits. Brock, you mentioned fractional reserve banking. We don't have to overcomplicate it, but when a bank gets our deposit, what are they legally able to do then?
Basically anything. Fractional reserve banking, very basic. I'm not going into it, but if Brandon gives me $1, I can loan Nate $10, even though it's not there, right? With insurance companies, if Brandon gives me $1, I'm only allowed to loan $1. And so the value of deposits for banks is the fact that they want to be able to receive it and then immediately push it right back out.
Yeah. As
Like,
fast as possible.
yeah, it is. Like, I've spoken to a couple bankers before, and if a banker cannot get 6 turns on a dollar within a year, they're not doing very well.
Let's talk about that turn real quick on a very, and Nate, I think you may have said something and alluded to this earlier, but if we use Brock's example there of turning that money, and you are turning money that is not really there, the profit margins are so much bigger than the average brain understands when it comes to banking. I'm not saying people aren't capable of understanding it. It's just not taught that way. Because once you have the conversation, most people are like, "Oh, that makes a ton of sense. I would want as many deposits as I could get to if I could legally do that." Brock, if you could give me money and I could lend out more than I actually have of your money, I'd be pretty wealthy pretty quick.
Hmm.
Yeah. But I'd
I
say,
think it's
like,
also go
there's
ahead.
something I'll add to that is, like, they do have, like, limitations on what's going on. And I don't think a lot of people realize, and we'll get into this a little bit later about, why the importance of having a whole life insurance policy where you know what the interest rate is going to be for the rest of your life, or not even just the interest rate, but guaranteed growth on that is so important. Because what most people don't realize is the fact that banks are hurting right now. When interest rates are 9% or 8%, and they're giving us 5.5, 5%, that's not as great, or it might be a little bit more of a struggle than when everybody was at 1%, if 1%, right? 2 years ago, most banks were paying 0.1%, but they could loan at 4, 5, 6%. So the spreads are much, much larger.
Yep. It's not about the rate of interest, it's about the volume of interest. A wise man once said that. Named Nelson Nash. But, one of the things that I think is really important is people need to vet the institutions that they're holding their money in. And the reason I say that is because we can use Silicon Valley Bank as an example. I personally know someone who lost millions in that bank because Silicon Valley Bank, even though banks are regulated, they were doing things that went unregulated, essentially, and they were definitely over leveraged. Like, I mean, that's what happens when a bank goes under. It's because they're over leveraged to a point where they can't dig themselves out of the situation. And we're talking about banks being businesses. Well, the job of a business is to turn a profit and to stay in business. They're like, so we can see some of these institutions out there that have been around that are sort of staples when it comes to U.S. history. And, we can be confident in some places more than others. So it's a good idea. And this ties into whole life insurance a little bit with these mutual insurance companies we work with. It's a good idea to make sure that we are properly vetting the institutions where we're holding our money.
Yeah, that's something that I get to conversate about often and we don't really think about this till it's asked in a way similar to this, is like, if you really think about it, there's only so many places you can keep your money. I mean, it's really not that vast. There's a couple of products here, a couple of retirement things there, but in the grand scheme of things, every place we keep our money, there is a partnership or a partner that we have, and there's an agreement. And we have to understand what those agreements are. So let's touch on another topic real quick, because I hear this often. I'm keeping this very 30,000 foot, and we can definitely dive into more details. But lots of times I hear, well, I know my dollar is insured up to 250,000 FDIC, which I don't think people really understand what that means. So, at a very basic level, without freaking people out, let's just talk about what that really means and how that works if lots of people wanted to get their money at one time from the bank.
Yeah, so there's this thing that happened in I think it was 1929. It was called a bank run, and everybody freaked out and tried to go get their money from the banks, and then they found out, oh, wait a second, we can't actually get our money. Very simply put, I think if staying as high level as we could possibly be, FDIC insured would be like, hey, if a bank went under and you had $250,000 in there, you would be able to recoup $250,000 back in your pocket. If you had more than that, you're probably not going to be able to recoup it. Now, today, things have progressed, and because of things like Silicon Valley Bank and all this stuff, most banks pool their reserves together, and they can insure, like with our current platform, our reservoir has FDIC insured limits of $3 million up to 6 million if it's a joint account.
Yeah, so it's definitely improved since 1929, but if you just keep it simple of what you started with, what you both explained so well, if a bank can lend more than they have on deposit, the math doesn't math somewhere if everybody wants their money at once.
Yeah,
Like logically.
banks wake up every day hoping today's not going to be the day that everybody wants their money.
Yep. Yep. And truth be told, would you guys agree that most people think because it's all they've ever known that the safest place to keep your money is in a savings account? I would say the majority of Americans believe that. And
Yep,
so,
most people think that, and they also think that when it's in savings, the interest that's being earned is enough to keep up with inflation, which when you really break it down and look at especially just what's happened in the last couple of years with price increases, like it's not even close to keeping up with inflation. People are talking about groceries being, 50% more than they were a year ago or whatever. Like you're not making 50% in savings. So there's a lot of price increases that have impacted people's money that they had sitting.
yep, that's exactly right. And, inflation is always, we can have a whole nother conversation about inflation, but it's really interesting. If you go to most banks right now, so I do most of my banking with Chase Bank, but I'm trying to shift to a local bank that I can really understand what they've got going on in their portfolio, because I can't stand the truth of what I'm doing, what Chase Bank is doing, whole nother conversation that I know now. But if you go to most banks and you really sit down and you walk in the door and you have a conversation with almost anybody at that bank, from the teller all the way to the whatever they want to call them, the manager of the store or the bank or whatever. I have found, because I have friends that are in those positions, that they, and I mean this nice, they don't understand banking. Like they have no context of what's really going on often. The people who understand banking are the ones way up the food chain who know what fractional reserve banking is and how money turns. Have you guys noticed that in a lot of your conversations in the banking world in general?
I would say for the most part, but they don't. It's kind of like they're in the jar. They don't have to necessarily. They just have to do their job, complete their job, and then go home.
Yep. Yeah. It's
Well,
more of just a job.
there's an example that I use often, and the reason why I use it so often is because of the feedback that I keep getting on it. And it's simply like most people don't understand how banks make money. And so the example of taking $10,000 down to the bank and they're going to pay me 5% interest. Well, somebody inevitably is going to call or walk in that same day needing a $10,000 loan. Well, at a basic level, they just took in $10,000 so they can loan that back out to someone else. And let's say they're going to charge them 10% interest. The average person looks at 5% and 10% and says, oh, the bank made a 5% spread on their money. But as we've talked about before, the bank's job is to turn that dollar over as many times as they can. And the difference between 5% and 10% is not 5%, it's 100%. So the rate of return has a far greater impact when you're using someone else's money to create value for yourself.
I think that's really where, Nelson says in Becoming Your Own Banker, we need to be in two businesses, the one we love and banking, and we better understand banking. So the way that I kind of simplify that sometimes is if we don't understand the basics of banking, then we are being taken advantage of by the process of banking, is the way my brain sees it a lot of times, because somebody else is utilizing that to their favor instead of our favor, which is really what we start doing in our daily conversations is, hey, if you just start taking a small ownership in the banking prospect in your life as a business owner, as a family man, as an entrepreneur, whatever the case may be, most people don't really realize all the advantages that come along with starting to take over the role of banking in your life. Like, it's really hard to wrap your brain around, and it creates a lot of times a fear because you're having to unlearn all these things you thought that was related to banking. Now, y'all mentioned 5% a couple of times. Here's the thing that I've noticed. Traditional banking right now is often charging you to have an account with them, and they're not giving anywhere close to 5%. It may be, like nothing at all. I mean, you have to go do a little bit of digging to find a place you can keep, money to get 5%. Would you guys agree with that? Do you see that?
Yeah.
Well,
You'd have to
anytime you
search for it.
Yeah. You definitely have to
Yeah, I
search
was going
for
to
it.
say, anytime you have interest rates go up, that's an opportunity for the banks to start marketing their high yield savings accounts again. But as interest rates change, obviously those rates are going to change, and so it's it's appealing temporarily for a bank to be able to go out there and start marketing, high yield savings again, get people into those products, whatever they are. But the bank knows that that's not going to be forever, but it's a great marketing tool when it happens.
Yeah. And I think a lot of people have forgotten that it was just like 2 years ago that banks were not paying those high interest rates. Like these interest rates are going to go up and down. They are going to cost you taxes. That's one thing I think more and more people keep forgetting it is the fact that it was just 2 years ago that we didn't have these interest rates.
So there's something that I had this conversation not too long ago. I had a member call and they go, "Hey, Brandon, I've got some excess cash. They already are members of ULC and they already pay a pretty decent amount towards premium per their income for whole life insurance. But they had a premium coming up again." And he said, "Man, they're offering 5% on an 18-month CD at my local bank." And I said, "Interesting. Have you asked yourself why?" And he goes, "Well, what do you mean?" I said, "Well, 6 months or so ago, what were they offering on CDs?" He goes like, "Nothing, 2-3% at best." I said, "So why do you think that they are offering an 18-month 5% CD?" This was about 6 to 8 months ago. And he said, "Well, I don't know." I said, "Well, let's think about it. What does the bank have to make money? Money. And what if they could lock in knowing that they could have your dollars for 18 months? And we go back to Nate's example of 5% and 10% and the 100% spread. If they could lock that in for 18 months, how sweet would that be for them?" And he said, "Oh, so what you're telling me is I can do the same thing through my system that I have because I have premium coming up and I don't have to give over any control of my money." I said, "Exactly." And so what you know, and Nelson said this, once you know what the problem is, you'll know what to do. I can't unsee these things now, guys. So like when I see the rates start doing these different types of things, well, you know what's going on, that they're trying to entice us through their products to give them our deposits. And the more safe we feel, the longer we keep our deposits there, which means the more money they make. And it's really that simple. Would you guys agree? In the grand scheme, there's a lot of reasons why or how, but
Oh yeah, there's a big difference between corporate finance and personal finance. What they try to make us think, and I think this is where if you can understand the fact that banks, institutions, government, all these people want our money on a consistent, systematic basis and hold on to it for as long as possible, you start to understand why because they're more focused on cash flow. Well, if they can get you thinking about the miracle of compound interest, oh, I got a dollar cost average. Oh, I need to pay off my house as soon as possible. Well, what you're doing is you're feeding their system faster than you are feeding your own system. And so it's kind of like, well, let's take a step back. Whose bank do you want to fund more and more often? Yours or somebody else's? And that's where we got to really sit down because it's like you think about these. I don't know why I'm thinking about it a lot right now, but 15-year mortgages and people saying, "Oh, you got to pay off your mortgage and you'll be good. It's like, one, expenses don't stop after that. But if you pay off the house, now what? Like, you just going to leave all the money there, or are you going to do something else?
Well, and our economy is run off the Keynesian school of economics. And when you think about interest rates fluctuating and everything like that, the reason why they fluctuate is because the job of the Federal Reserve is to make sure that money is always attractive to borrow. Like they have to play this balancing act with what's going on with the economy and everything like that to make sure that money is always attractive to borrow, because when it's not, the whole system grinds to a halt. Well, they've got to keep money flowing at some rate. Otherwise, everything falls apart.
Yeah, I don't know why this just jumped in my head, but somebody wrote a book, and I'll find it and we'll try to put it in the show notes. It's a little kid's book about Beaver the Banker, and it does a great job simplifying that what does water do when it's dammed up if there's no flow of new water in or out? It gets dirty, it gets stagnant. So there has to be a flow somewhere for the water to stay pure and clean and beneficial to who all it's impacting, the environment or whatever the case may be. And that all makes perfect sense, except for when you go to the traditional way that we've been taught to think about banking. It's like, for lack of a better term, it's like playing Russian roulette and trying to move some of those levers that Nate just alluded to try to keep enough flow, but get enough deposits and all these things, because of what Brock said at the very beginning, because there's not sound money thinking tied to it. It's built on a faulty premise of I can take $1 deposit and I can lend out more than $1. Like, logically, that does not make sense, which is why we are such big proponents of the guarantees with whole life insurance, because there's no guessing, there's no ifs. It's basically, when we do this, this happens. So, Brock, you mentioned earlier currents. Currents is really a mindset that has software connected to it. All that is under the hood is a bank. So at a high level, let's touch on the psychology with the benefit that has for our members and people that begin to use it, and then any other key pieces and kind of how it's been very beneficial for us and for our members. I think I heard this said yesterday, and it might have been on our guys at Warehouse of Wealth, their podcast, Paul and Dave. But we've been so entranced with this idea, or lured into this idea, that we need to have this huge accumulation of money at the end of our retirement, when we hit retirement. But all we really need, because that's a drawdown theory, all we really need is an income plan. And Brock, you just alluded to that with currents. Currents can help us have an income plan. So said another way, if I'm 35 years old and I can clearly start systematically, behaviorally creating a plan that will provide me income, whether I am working my 9 to 5 or doing this or doing that, do I really have to accumulate over the next 30 years the way I've been taught to think I have to? I don't know. I don't think so. If I have an income plan, because that's all we really need, right?
I think it's way easier to focus on an income plan, a cash flow plan, than it is trying to accumulate to some massive number that you may never achieve following the traditional ways. Because with an income plan or a cash flow plan, you can start to really see progress as you're taking a bite, little by little. But when you're trying to accumulate to some number, because the goalpost keeps getting moved, when it comes to increases in costs of things, when it comes to increases in taxes and everything like that, that's the reality. The goalpost keeps moving. So if it keeps moving, how do you even know you're making progress?
Yep. It's hard to make progress when the target continues to change and you don't control the changing of the target. And that's a big piece. So to really kind of frame this all in, we're not telling you to just take our word for it. We're encouraging you to go, how do banks operate? And you don't have to understand all the nuances. You just have to scratch the surface of, if banks' job is, if their goal is to make money off my deposits, if I could recreate that in my life and gain more certainty, more control, more peace of mind, why would I say no to exploring that? I had coffee with the guy the other day and I kind of walked through that simply. I said, right now, when you put your dollar anywhere, what are the things that occur for you? And he kind of went through them. And I said, okay, when I put my dollar here, because he already understood whole life, so he was just picking my brain. I said, I get these guarantees before I do anything else. So I told him I get an internal rate of return guaranteed. I get an external rate of return based off of how I use it. And then my lovely family gets an eternal rate of return guaranteed, because it's not if I die, it's when I die. And he goes, that,
WHEN.
yeah, WHEN. That's exactly right. He goes, that makes so much sense. I'm like, good, because I'm normally the one not creating clarity. That's normally Nate. I normally create confusion because I say too many things. So he said, that makes so much sense. I said, it really is that simple. He said, so the hardest part is the fear piece, because that's not what we're taught. I said, you hit the nail on the head. That's exactly right. So what we really encourage everybody to do is just explore the idea that they could start controlling this process in their life. And then as you start taking action, guys, you start getting much more clarity on how beneficial it is to you in your own life because of those basic things. So
Well,
guys, is there any
Brandon,
other key point you want to touch on?
yeah, you brought up fear, and I think it's safe to say, even for us, one of the early hurdles that we had to get over was our money's not going to sit in a bank. That's weird. Like that doesn't make sense. But as you're saying, what we're doing is we're challenging you to go do research for yourself. Hey, research the track record of the banking industry, but also research the track record of the mutual life insurance industry, and you'll start to see where there's massive financial stability in this industry.
I would add a couple things. So I think it's a couple things. So first would be, I don't think people realize you could go look at a bank's finances. Like you could go to the FDIC.gov and pull up any bank that you really want to look at. Pinnacle, Wells Fargo, any of that stuff if you really wanted to. And I always like, every once in a while I'll go check it out and I'll go look at their balance sheets. And I like looking at lines. I believe it's lines like 35 through 41, 42 to see what they got cooking right there. Because that's like, those are usually the important pieces. Um, and I'll let people go look at that to figure out what those lines are. But so I would first think about that. But then, we got to understand there's a big difference between saving and investing, and where you hold your money is very important, right? If we're investing, that means we could lose money. If we're saving, that means there's no risk on the money. We're not going to lose it, right? And so you got to be very clear about, hey, where am I saving my money? Before it goes into an investment, before I go risk it somewhere, where am I holding it where I know there's going to be no risk of loss? It's protected in the event of maybe lawsuit or bankruptcy, and it's liquid that I can get to it in 7 days or less.
Since you brought up balance sheets, I think it would be important for us to point out that the big banks that are out there have billions and billions of dollars of whole life insurance because it is their tier one asset, which is the most stable asset that they can list.
You gave it away there, Nate. If you went through lines 38 to about 42, that's what's on the balance sheet.
And when you look at that, if you do go do that, please let us know, and let us know what your questions are, because why would a bank own that much tier one capital in a product that we believe in if they didn't believe in it themselves?
Something else, two other things that if somebody does go and look at this, which I hope they do,
Yeah, me too.
there's two things that I would really like to know. One, comparison that on the bank's balance sheets of what they hold in real estate compared to what they hold in life insurance, comparison of values. And then two would be, in the years that banks crumbled, what did mutual insurance companies do? Did they crumble or did they continue to make profits?
That's good stuff.
I
All
have
right.
one last question. Why does Dave Ramsey tell people that banks don't own life insurance?
We may create a hornet's nest there if this makes it out into the World Wide Web.
I mean,
I'm
it's
sorry,
on YouTube. You can go
what
find it.
that he says what?
Dave has said on his radio show, banks don't own whole life insurance.
Yeah, well, I don't really care what Dave says. So
Yeah.
All right. So to sum up, we got to know what's going on in banking at least some basic level, or we will always be the product of banking and never the beneficiary of banking. Simple as that. Next thing, next week, we're going to talk about taxes, but we're going to make it fun. We're not going to freak anybody out, but we're going to walk through how you can really, truly pay the amount you're required, but not a dollar more. And most of us are paying way more in taxes than we realize we have to. and it's all about just kind of like with banking, you got to understand what's going on, then you'll know what to do. So leave us a comment. We love those 5-star reviews if you feel like we're worth that. And definitely drop any questions. And if you went and checked out those line items on the FDIC, we'd love to hear your thoughts there. Maybe we'll do a podcast on that specifically and just have a discussion on it and look at it one day. That'd be fun too. So hope you all have a blessed day, and we'll see you on the next one.